So, the first part of Chapter 3 covered the basics of demand, and now we're going to go ahead and cover the basics of supply. Again, we want to think about this issue of price versus value and cost. Price, we talked about, is what actually happens in the transaction, the amount of money that changes hands. Value is the subjective internal estimate of the benefits of the purchase that the buyer gets. The net benefits, remember, we called consumer surplus, and consumer surplus is the customer or consumer's willingness to pay minus the price they did pay. We're going to also have cost, which is the seller's subjective assessment of the costs they incur to make a sale. And that would be figured with both psychological costs and using the opportunity cost concept. So it would include both explicit costs and implied costs due to lost benefits. And we'll often call this just seller costs. So just like we had a really simple model of demand with a group of potential sellers of our concert tickets, we're going to have a simple model of supply where we have a bunch of potential sellers of concert tickets. Each seller can either sell zero, that is, they don't sell their ticket, or they can sell one ticket, depending on whether the price is above or below their seller cost. So here are the 5 different sellers we have. We have Carrie, who has a seller cost of 55, Linda with a seller cost of 45, and so on and so forth here. And remember, sellers like high prices, and they don't want to sell for a loss. It's actually really common for students to have difficulty changing gears from thinking about things in consumer surplus terms to thinking about them in producer surplus or supplier terms. So we want to think about which sellers are willing to sell at a given price. For instance, at a price of 18, only Reed has a seller cost that's lower than 18. So only Reed can profitably sell at a price of 18. Nico has a seller cost of 25. And obviously he doesn't want to sell his goods for $18 if his costs are 25. He would take a loss on that, and so on and so forth. So at a price of 49, everybody except Carrie is a willing seller because Linda, Molly, Nico, and Reed all have seller costs lower than 49. So using that kind of logic, you want to go ahead and think about if the sellers can get a price of $33 for their tickets, how many sellers are willing to sell? We can also use that data to show the supply schedule, just like we showed the demand schedule. And in particular, we want to think about at each price, what is the quantity supplied? So at a price of $55, that matches or is higher than the seller cost for all the sellers. So all the sellers are willing to sell at that price. And the convention is that we assume that sellers are willing to sell when the price exactly equals their seller costs. Even though they wouldn't actually make any profit, at least they wouldn't take a loss. Further declines in price once we get below $55, Carrie becomes an unwilling seller because the seller cost then is higher than $54. At a $45 price, we have 4 willing sellers. Once the price goes below 44, Linda becomes unwilling to sell because she would be making a loss at $44, and so on and so forth here. When we finally get down below $15, we have 0 willing suppliers. Like before, we can go ahead and turn that into a picture. So our supply curve here is going to be at a price of $15, we're going to go ahead and have 1 willing supplier. At a price of $25, we'll have 2 willing suppliers. And again, this would be a step function. Actually, at all prices below $15, we would have 0 quantity supplied. Then once we hit $15, it jumps out. Further price increases don't produce any increased willingness to sell until we get to $25. Then our second supplier becomes willing to supply, and so on and so forth. So again, this would be a kind of step function, and that would map out our supply curve. We had consumer surplus as our measure of the net benefit of participating in the market for consumers. Producer surplus, also sometimes called producer surplus value, is our measure of the net benefit producers or sellers or suppliers get from participating in the market. And the producer surplus from an individual sale is the amount that the producer got paid, the price received, minus their opportunity cost or their seller cost. And I've written in here opportunity cost because I want to emphasize that it isn't necessarily the historical monetary cost. It might be forward-looking, like, what could I sell it for next week? In the market as a whole, because the height at each point on the supply curve is dictated by that seller's seller cost, so the height of the third dot was dictated by the $35 selling price for the third willing supplier, we can go ahead and think about measuring producer surplus in the market as a whole as the price received minus the seller's opportunity cost. So the price received is going to be the height here, and the seller's opportunity cost is the height of the supply curve. So if we had a $35 price, then producer surplus would be the area of this triangle here, because we would be taking price and then subtracting off the seller cost at each point. So based on that kind of situation, if the sellers can get $49 for their tickets, what is producer surplus in the market as a whole? And you want to go back and think, okay, who are the willing sellers if the price is $49? And for each willing seller, what is their particular producer surplus? And then add up across all the different producers. I'm going to go ahead and skip ahead and just show you the supply curve shifting. So let's suppose the band announces that this will be their last tour, so our sellers find it more painful to part with their tickets because they suddenly realize they might not get a chance to see the band on tour again. So where Carrie had been willing to sell for a price of $55 because that was Carrie's seller cost, now he is only willing to sell if the price goes up to $75. And Linda, who had been at $45, is now at $65. Remember, this $75 is the minimum price Carrie requires before he's willing to sell. So a higher price means the supplier is less willing to sell. So we can see that the supply curve would become $20 higher at each point. And remember that that means that at each price, say $35, instead of there being 3 willing suppliers, now there's only 1. At a price of $55, instead of there being 5 willing suppliers, there's now only 3. And this is a common confusion. People usually don't have a lot of trouble shifting the demand curve in the right direction because a higher level of demand is up higher and it's going out farther. And I think that's very intuitive for people. But when we talk about the supply curve, higher is actually the same as a leftward shift. So higher price is the same as fewer willing suppliers at every price. And so we'll go ahead and come back to this later, but when you're shifting these curves around, remember that left is a lesser level of supply and demand, right is a higher level of supplier demand. So in this case, because the sellers have experienced an increase in their psychological selling cost, we have a leftward shift and a lower quantity supplied at every price. There are some other things out there that could go ahead and shift the supply curve. And I'm going to go ahead and concentrate on things that would shift the supply curve right. So that's the opposite of the example I just did. So one would be is if sellers have lower costs. That could be lower opportunity costs of the inputs because the inputs have just gotten cheaper. It could be something like they have technological innovations which allow them to generate more output per unit of input, so that would lower their costs. If we just had more suppliers entering the market, that would go ahead and lead to an increased level of supply, which is a rightward shift, because left is less and right is more. I've put usually here because this gets a bit tricky. If we have several existing suppliers and we break them up into smaller suppliers, that might not lead to a higher overall level of supply. In particular, of course, you have the same capacity just split up amongst a smaller number of firms, so it might not change the level of supply at all. But there could even be a case where if you split the firms up into a small size that's sort of inefficiently small, that could actually decrease the overall level of supply in the market. And we'll come back to that sort of thing later when we talk about monopoly and economies of scale and that sort of thing. So another thing that could cause firms to be more willing to sell now is if they expect prices to be lower in the future. They're more willing to sell now because they'd rather sell at today's relatively high price than tomorrow's relatively low price. And if they expect a higher future supply, well, of course, we'll see later in chapter 4 that a higher future supply will tend to drive down prices. So if they fear there's going to be a bunch of competitors that come into the market now, they might as well, they fear there's a bunch of competitors that are going to come into the market next year, they might be trying to dump their inventory now before prices decline. As it says here, if any of the above are reversed, then instead of the supply curve shifting right, the supply curve will shift left. We already covered the data for this and how it went into the graph. And so here are review questions for supply shifts. We want to go ahead and look at those, and then we'll cover them on the MyCR quiz. And that's the end of the supply video.